And welcome to VC House. Let me introduce Joseph Mocanu from Singapore. He's managing partner of Verge HealthTech fund. And today we are talking to Joseph about his fund and his VC secrets.
Wonderful. Thanks so much, Alexander, for having me here. It's an honor.
Joseph, at first, can you tell me about your fund strategy, geography, stage checks, industries?
Sure. So you probably might have inferred from the name of the fund that we do health tech, and we are the world's first seed stage fund that does health tech globally, and we invest in technologies that expand access, quality, and efficiency of healthcare across emerging markets. So that doesn't stop us from investing in developed markets or companies domiciled there, but the applications and the relevance really have to be to the 4 billion people that don't have proper access to healthcare.
Okay, thank you.
Our typical check size is 250,000 US dollars. We can go a little bit higher, and we do really like to be the first or just after the first investor in a company.
Okay, and once more, you are investing globally.
That's correct.
Okay, really great. So it should be interesting for many startups. And what is the age of your fund?
So we started at the end of 2018, and we've been around now, for almost 2 years, and we've now invested in 9 companies and working on a few more.
Oh, great, great. And how many managing partners do you have in your fund?
We have 2 partners. I founded the fund, and then my longtime friend and business partner, Ed Dung, is the other partner.
Okay. And Joseph, tell me please about yourself and what was your motivation to become a VC?
Well, I think it goes back probably about 18 years ago, where I had accidentally co-founded a medical device company while I was doing my PhD. And we needed to get to the next stage, which meant taking some external investment. We were really lucky to have an angel investor who is kind of a really founding father of Medtronic, who worked alongside Earl Bakken, who's the founder, who believed in us. And then once we had the prototype, it was time to go to the next stage. Unfortunately, every VC we talked to in Canada, which aren't that many VCs, said no to us. But at that time, I thought, wow, that's such a cool profession. You know, you get to choose the future in which we live by supporting or not supporting startups. And I kind of had that in the back of my mind for the longest time. When I went through business school, I wanted to become an investor. Then I learned that management consulting skills could be useful to add value to your investments. And I chose that path for a while. And, I thought I was only going to do that for 1 or 2 years, but ended up doing it for almost 8 years. And it wasn't until I moved to Singapore with my old company in 2014 that this idea, to become an investor came alive again. And it first manifested through angel investments when I met all these really great founders that were solving a real big problem in healthcare and couldn't get that first investment. They thought that they were too slow, too regulated, too technical, overall too risky. So as a consequence of understanding both the market and the technology, I thought, hey, why don't I write some checks? Why don't I start investing in these founders? And before I knew it, I had invested in 13 startups, 10 of which were in healthcare technology. And it also kind of saw the results of the work. They grew in value. They really impacted a lot of people's lives, and realized that the only reason I go to work every day is to support these founders, and I really needed to do this full time. So the first step, the first thought that goes through my head is obviously not to start a fund. I mean, starting a fund is really difficult, and I've never worked in VC, so what right do I have to actually start a VC? So I looked around the world for funds that were doing seed stage health tech, investing in emerging market problems, and I couldn't find any. So then I realized, oh, nuts, I have to start one. And so I did, and here we are.
It's a really interesting story. So you could not raise funds for your own startup and you see the niche in which you can work because nobody wanted to invest probably on seed stage, yeah, uh, globally. Really, really interesting story.
And it is really a global problem. I mean, we looked at some of the data. So in addition to anecdotally what I encountered in my journey, the data supports it. I mean, 75% of all health tech deals are Series A or later, and that is a stark contrast to 40+% for all other industries. So you're potentially losing a lot of really interesting innovation simply because the startup wasn't good at raising capital or was born in the wrong country. And where there are a lot of seed stage health tech investments are really just in the United States. Even in Israel, there is a paucity of seed stage health tech investors relative to other sectors.
And I know that the next question is hard, but nevertheless, uh, can I ask you what is the most successful or promising startup in your portfolio, in your opinion?
Oh, that's a tough one because you're asking me to choose my favorite kid. We have 9 companies. Some of them are doing better than others, but the companies who are doing better than others change over time. So sometimes one company is doing really well, and a month later, they've encountered some hiccups, and another company has pulled ahead surprisingly. So if we want to talk about absolute investment received, our very first investment, which is ReadySpec, is using hyperspectral retinal imaging to look for early signs of Alzheimer's. And they just issued a press release yesterday where they're working with Gentex, which is a NASDAQ listed company, on the commercialization of their detection technologies. So in terms of where they are the most mature. They've had the most time to mature, and they've raised the most money out of all of our companies. And of course, they have the highest valuation as a result of this. But again, we shouldn't look at valuation as the sole measuring stick of a company's success. There are many other factors, and they could all die tomorrow, which I hope they don't, but it is a real possibility.
Yes, I would agree with you. And nevertheless, how has the valuation of the startup changed from the moment you had invested? Can you tell us about it?
I can tell you that it has gone up in several multiples, and that's what I can say.
Okay, no problem. And can you recollect how and where have you met the founder of this startup?
So this was quite serendipitous. So I'd mentioned Israel for a reason. I actually took a trip to Israel in 2018 summer to see what's going on, understand the scene, because it was considered a hotbed of innovation. And I hadn't been to the country in I guess almost 20 years. So I had a few contacts on the ground who could introduce me to a few companies. And I was introduced to 9 companies, one of which turned out to be Israeli founders, but not actually physically in Israel. But it so happened that the COO was present for a wedding. So when I reached out to him, we met up for a drink in one of the suburbs of Tel Aviv, and he told me some really cool things that I thought were quite interesting. And then I asked a bunch of technical questions, and then he referred me to his CEO, and I asked his CEO, where does he live? And he said, Toronto. Oh, interesting. So I did my PhD in Toronto. I lived in Toronto for half my life. And, upon going to Toronto the next month, because I have family nearby and some friends, we really got along. We really spent a lot of time together. And I also learned of a few other serendipitous features, like the chief scientific advisor of this startup was on my PhD thesis defense committee, as well as a world authority in biophotonics. Now, he was spending a day a week at that time with the company, whereas it took me 3 months to get 1 hour with him when I was doing my PhD. So I thought, okay, this is really serious. And then, of course, upon deeper due diligence and looking at the work that they've done, it seemed to be really the right call, because you had the combination of excellent team, excellent technology, product market fit, my deep domain understanding of what they were doing, and all these serendipitous coincidences. So we thought, okay, we have to make this investment.
Great. So it's not really a very typical way of meeting the startup in this case, yeah? And
No, not
how
at
do
all.
you usually search out for prospective startups?
So there are two ways. There's inbound and outbound. So we have a couple of problem statements that we really kind of look for, and that's our secret sauce, and we don't really disclose that. And then at conferences or through startup databases, we'll look for startups that potentially can address some of these problem statements. Or if we're introduced to a bunch of startups, we'll prioritize these. But we also want to keep an open mind. So we a lot of our startups are introduced to us either through our advisors, our venture partners, other funds, incubators, accelerators, even professional services firms like our law firm introduced a startup to us. But the absolute best referral source are other startups because they know who's real and who's full of fluff.
Mhm.
And those go straight to the top of our list when we go to evaluate. And the reason I like referrals is generally speaking, they know what we look for. When we have a high volume of inbound unsolicited requests for capital, and most of us, most of them don't actually know what we do and what we look for. And they haven't taken the time to research this by looking at our website, our portfolio, or anything else. It's kind of a spray and pray approach, hoping that some people will respond, which may work if you're a generalist fund and you're targeting, or sorry, rather if they're targeting a bunch of generalist funds, but it generally will not work if you're very thesis driven and focused.
And what is the easiest way for the startup to apply to your fund?
The easiest way is to get an introduction through someone that knows us really well,
Okay.
because then that gives you that qualified lead, which the introducer is willing to risk a bit of their personal reputation by making that introduction.
Very interesting point of view. Thank you. And did you lead or follow the round in that startup about we are talking now?
It was it's interesting because the startup actually led that round, believe it or
Sorry?
not.
Okay, can you repeat, please?
Yeah, the startup led the round. So they basically said, we need X amount of money. This is what we're working on. These are the terms that we think are fair. And, we negotiated a bit and that ended up negotiating for everybody. And then we, this was the first financing round in the company. It was the absolute first external investment in the company. And it was early, so we took a bit of a leap of faith and we managed to get enough of the terms that we thought were interesting. But it was actually the startup that was driving the process, which is extremely rare and really only happens when you have a serial entrepreneur who knows what they're doing. For 7 of the 9 companies, we led the round.
For 7 of the 9, you lead the round.
Yeah.
Okay, so this is typical for you to lead. Okay.
Yeah.
Okay, good. And how fast have you taken the investment decision with that startup? Was it week, months? Was it faster or slow than usual? Can you recollect?
It took about a month for us to make the decision from first meeting to yes, we'll do this. And it really varies because sometimes we literally had 2 business trips in between meeting the COO and meeting the CEO. And had we have actually calculated the amount of time together, it probably would have been about 7 hours in total to go from start to end. It's just how do you schedule that 7 hours in order to make that decision? And some other investment decisions were a lot faster. Some were also a lot slower.
Okay. In other words, you spent 7 hours for due diligence, yeah, and taking decision.
Yeah, well, frankly, the company was so early, there wasn't a lot to diligence other than, do you have a company registered? Show me your IP, and then let me meet everybody involved.
Okay, yeah, probably the team is the most
It's
important,
first.
yeah, on this stage.
It really is.
Okay, and you are investing on in seed rounds, yeah? And so
Yeah.
what is your opinion about investing in seed? because many funds just don't want to invest so early.
Yeah, because it's scary, it's risky, there's a lot of things that can go wrong, and it takes a lot of time. I completely understand. But remember, the first goal of investor is make returns. It's not live off of fees, it's make returns. So how are you going to make returns? You either go hunting for unicorns, and you hope that whatever you pay for the startup will still yield you 40 to 100x because you've made a unicorn, or you look for consistently good solutions to problems that large corporations will want to pay, 50 to $200 million for. And I personally don't have confidence in my ability to find unicorns, but I have more confidence in my ability to find good solutions to real problems. And if that's the case, and I need to return a healthy return to my own investors, we need to buy low. I mean, the first rule of investing is buy low, sell high. So if we have to buy low, where the heck can we buy low? By the time a company is Series A or Series B, chances are there's a ton of investors who have driven up the price of the company. So we have to come in earlier, and that's simply what we have to do in order to get the return. And the other point of view is, because we're all ex-founders, we're all from industry, we like to think that we can add a lot of strategic value to the company. And I find that the founders are most open-minded in the very early days. It's really easy for a small little boat to change direction very quickly. But if you're a very large yacht funded by $30 million of VC capital, and you have to make a very sharp turn to the left, it's going to be very difficult for you too.
Mm-hmm. It's really interesting point of view. Okay, thank you for this comment. And I know that every fund has really a lot of criteria in the process of analyzing the startup. Can you tell us the most important personally to you?
Yeah, well, every VC will say team. I'd like to go a step further. We need to see commercial, technical, and clinical expertise and experience. We need to understand the motivations and the values of each of the team members. I mean, why are you doing this? A startup is really hard, and a healthcare startup's even worse. So it's going to be, 10 years of pain before you see potentially anything good coming out of this. So we really have to understand why you do it. Of course, you have to have a real technically differentiated solution to a real validated problem. And the problem has to be, both serious as well as widespread in order to have an appropriate addressable market where you can hope to, have some measure of success and impact. By defensible, it doesn't necessarily have to be patents. It can also be trade secrets. It can be proprietary networks. It can be business models, but you need to have some sort of edge that you can defend over time. And I guess the last thing is, do we get along? Can we add value? And I think personal fit's really, really important. Maybe I can become an interviewer and ask you a very personal question. Are you married, Alexander?
Yes, absolutely.
Yeah. And with your wife, how much time did you spend with her before getting married?
With the first wife or with the second wife?
You can answer whichever one you want.
Okay, yeah, it takes yeah, or maybe 2 or 3. I understand.
Yeah, exactly. And the average marriage in the US, for example, lasts 8 years, which is coincidentally about the same timeline as a VC fund lasts. So why is it that we're making decisions to invest in something after a week, when it's something potentially as important as getting married? So similarly, when a startup gets together and decides to create itself with some co-founders, The ones that generally seem to work quite well are the ones where the people know each other for a long time, as opposed to, you know, being thrown together at the last minute. So these are really long-term decisions that have a lot of impact. So it's really, really important to understand values above everything else. And this is something that I don't see so much articulated in the investment community, although I know that some funds are putting this forward as their core thesis.
Yeah, I agree with you. And I've heard, you know, the statistical fact that if the venture fund, spend more than 40 hours to due diligence, the results can multiply to 3 times. Would you agree with this?
I would absolutely agree. I would also want to qualify what due diligence means, what the nature of the due diligence is, and perhaps it's a comment on the fact that a lot of investors maybe don't do enough due diligence. So even that example of 7 hours of in-person time spent with ReadySpec before we invested doesn't encapsulate, you know, all the interactions, the emails, the articles read, the informal things that we looked at. So we could say that we easily spend more than 40 hours on it. And also over the course of a few months to really observe. And to be honest, that's one of the fastest investments we've made in terms of knowing the team, because we had a bit of time pressure because they were going to go ahead and raise this money without us, with or without us. And it was that promising, and we wanted to make sure that we got in. And then there's other companies which we observed for 2 years.
Mm-hmm, mm-hmm. But yes, I agree with you that sometimes you really don't have much time to make due diligence and to analyze for a month or more. Absolutely.
Mm-hmm.
And Joseph, now it will be a really tough question.
Sure.
Can you tell us about your personal investment biggest mistake?
Sure. I mean, I think part of it is, actually there's several mistakes, and I can share a few mistakes with you. Number one mistake is not being as disciplined on the valuation. This is something that I've made sure not to repeat when we started our fund, but sometimes we might have overpaid for some companies just because we, you know, we didn't really have as sophisticated of a sense of what the terminal value of the company might be and what the expected return might be. I think, especially very early in my angel investing experience, I kind of I kind of drank the Kool-Aid too much on let's not worry about the valuation now because it'll all even out later. I think that's completely bogus. I think you have to be disciplined from the very first day. The other one is really testing maturity and execution ability. And I'm, knock on wood, I mean, to date, out of all my investments, I've only lost one company, and it was one of my very first ones, where, you know, I didn't take the time to really assess the ability of the team to execute. I was too fixated on the product and the great opportunity that it had, and it really did. It was an excellent product, had great product market fit, but we didn't scrutinize the team's experience and ability to execute enough. And when I think about all the problems in any of my investee companies, you know, over the past 5 years, they've never been about product market fit. They've never really been about strategy either. It's all been execution.
Very interesting. Very interesting. Okay, so Joseph, my last question for today.
Sure.
What is, in your opinion, the secret of your success?
I would argue that we're not successful. And I think that we won't know whether we were successful until 10 years from now. And that's unfortunately really how long it takes. Because, for example, if we get a fantastic exit, you know, company made us 100x, returns the fund, everything's great, but everything else goes to zero. Are we successful or are we lucky?
You probably read Daniel Kahneman, yeah? Thinking Fast and Slow, this book. Yes, this is a really good question, and probably we don't know the answer to it.
Yeah.
It's
But
really,
I like to think that we're different. We take a bit of a contrarian view on things, and generally speaking, if people do things a little bit different from anyone else, we might have a higher chance of being successful. Of course, we could also be completely wrong because, you know, if everybody doesn't jump off the cliff and we jump off the cliff, being contrarian is really stupid in that case because we've jumped off the cliff and we're dead, and other people have, you know, been a bit more wise with their lives.
Joseph, thank you very much for your
Uh,
openness and advices. And I wish good luck to you and your fund. Thank you.
Wonderful. Thanks so much, Alexander, and thanks again for having me here and for your great questions.